A major weight loss drug manufacturer experienced a significant 25% nosedive in stock price today after new safety data emerged, prompting investors to reassess their positions in this previously hot sector. The safety concerns raised by regulatory authorities have cast a shadow over what was once considered one of the most promising pharmaceutical segments, with analysts now questioning whether the company can maintain its market leadership position. This dramatic decline reflects the growing anxiety among healthcare investors about potential liability exposure and long-term efficacy questions that could reshape the competitive landscape for weight loss medications. Meanwhile, shares of a leading artificial intelligence chipmaker soared more than 10% in today's trading session, driven by stronger than expected earnings guidance and robust demand signals from major data center operators. The company's outperformance underscores the continued investor appetite for companies positioned at the forefront of AI infrastructure development, despite broader market concerns about valuation multiples in the technology sector. Market participants are increasingly confident that this chipmaker can sustain its growth trajectory as enterprise clients accelerate their artificial intelligence initiatives and capital spending plans. These divergent moves illustrate how company-specific developments can drive individual stock performance, regardless of broader market trends and macroeconomic conditions. When a single company announces transformative news, whether positive or negative, its stock can move dramatically as investors rapidly reassess fundamental assumptions about future earnings potential and risk profiles. The weight loss drug manufacturer's safety revelation demonstrates how regulatory surprises can instantly undermine investor confidence, while the AI chipmaker's positive guidance shows how execution excellence and market tailwinds can create powerful momentum. The contrast between these two stocks serves as a critical reminder that your investment portfolio cannot remain static or on autopilot if you want to protect your wealth and maximize returns. As new information emerges about individual companies within your holdings, you must be prepared to evaluate whether your original investment thesis remains intact or if circumstances have fundamentally changed. Investors who held significant positions in the weight loss drug stock without having a clear exit strategy when safety concerns surfaced may now be facing substantial losses. Portfolio adaptation requires developing a disciplined framework for monitoring company-specific developments and understanding how they might impact your holdings' long-term prospects. Rather than simply buying and holding indefinitely, successful investors maintain awareness of competitive dynamics, regulatory environments, and evolving business fundamentals that could trigger meaningful revaluations. The stock market constantly reflects new information about individual companies, and your portfolio should reflect your current assessment of risk and opportunity, not decisions made months or years ago. Diversification across sectors and individual securities can help mitigate the impact of company-specific shocks like the one experienced by the weight loss drug manufacturer today. However, even diversification cannot fully protect you if you've concentrated too heavily in any single stock or sector without clear rationale. The sharp divergence in performance between the weight loss drug company and the AI chipmaker highlights how important it is to understand not just what you own, but why you own it and under what conditions you might need to reconsider. Risk management becomes particularly important during periods when individual stocks experience extreme moves based on specific corporate developments. Investors who had positioned themselves defensively by setting stop-loss orders or limiting their exposure to the weight loss drug stock would have protected themselves from the worst of today's decline. Conversely, those with the conviction and risk tolerance to increase positions in high-quality AI chipmakers during market weakness may find themselves rewarded as this megatrend continues accelerating. The broader implication of today's market action is that investment success depends on remaining vigilant and adaptable, rather than passive and complacent. Your portfolio is a living document that should evolve as your understanding of individual companies, industries, and market conditions improves. By staying informed about company-specific developments, maintaining a clear investment thesis for each holding, and being willing to make adjustments when circumstances change, you can position yourself to benefit from opportunities while protecting yourself from unnecessary downside risk.